All right. I just realized that I read like, I don't know, 4 pages. I was recording and not streaming, so sorry. Let's see, what page did I start on with? There was, I think it was this one right here. Yeah. Really interesting stuff. So I'm just going to skip through it and you guys can read it. And you guys can pause the video and then read it. So I can catch back up to where I was before, so sorry about that. These zero coupon bonds are pretty interesting. All right, so here we are, callable bonds. This is where I was leaving off. All right. So, callable bonds are bonds that can be called, redeemed early at the option of the issuer at a pre-established premium price after a specific date. So, um, the call provision of a callable bond will specify the callable date and the price at which the bond will be called. Call features are advantageous to issuers, not to investors. Because a low call price would be an attractive feature for an issuer, and a high call premium or price would not be attractive to an issuer. A call price can place a ceiling on the appreciation possibilities of a bond, since a company might call in a high coupon bond if the interest rates decline. Call protection is the fixed time period during which the bonds may be called by the issuer. Bondholders want interest rates to decline during the call protection period, and bondholders want bond prices to rise during the call protection period. The higher the coupon rate on the bond, the greater the chance that the issuer will call the bond, because the issuer can retire the higher interest bond with a new bond at a lower rate. Bonds are preferred stock. Bonds and preferred stock may be callable, but common stock is never callable. You call me, I call you. Call me. But if you're common stock, you can't get called. All right. When a company calls its bonds, the bondholder receives a premium called the call premium plus the accrued interest. The premium is the amount paid on top of the par value of the bond as additional compensation for the early redemption. Creditworthiness of the company improves because they have less debt, and debt to net worth ratio improves because it decreases. Prior to calling bonds, the issuer must give the investor notice of call, stating the date the bonds will be redeemed. During this time, investors may convert the bond, sell the bonds, or wait for the redemption date. So prior to the calling, the issuer must give the investor a notice of call. So during this time, investors have three options. If the bond is convertible, they can convert it, they can sell it, or they can wait for the redemption date. So if they're going to make a call, they can make a market decision. Investors would choose the option that puts the most money in their pockets, because obviously it's investment. Interest payments stop after a bond is called, and callable bonds usually trade at a lower price because the call features are undesirable to the investors. When an issuer decides to call bonds, it can make a partial call where only part of the issue is redeemed. When this occurs, the bond which are called are selected on a random basis from the entire issue. Convertible bonds. Convert to shares of common stock at the option of the bondholder. Converting a convertible corporate bond into a common stock would not be considered a taxable event until the stock was sold. Bonds are converted at a specified rate, called the conversion rate. The conversion price tells you how many shares of common stock the investor would receive upon the conversion. The formula to calculate the number of shares upon conversion is par value divided by conversion px equals common shares received. So example, a convertible bond has a conversion price of $50. How many shares of common stock is produced if the bond is convertible? Well, I don't know what conversion px is. Page 37. Oh, px is the 50. So the conversion price is 50. And the convertible bond has conversion of 50. How many shares? So it's 1,000 divided by 50. Yeah. Right? Yeah. 1,000 divided by 50. Cool? The coupon rate of a convertible bond is normally lower than on non-convertible bonds. So the coupon rate on a convertible bond is normally lower than on a non-convertible bonds of the same quality. This is due to the convertibility of the bond into common stock if desired by the investor. A conversion feature allows bondholders to participate in the growth of the corresponding equity security. Convertible securities typically will not have more. Convertible securities typically will not, or will have, sorry, will have a more volatile market value than those of non-convertible securities because the convertible value is tied to the market value of common shares and common stock values typically fluctuate more than preferred stock values. Refunding bonds. The sale of a new issue of bonds, the proceeds of which are used to retire an outstanding issue. Refunding is generally done when there is a sharp decline in interest rates. Calculating parity on convertible securities, forced conversions, and bond refunding. Parity means equal value. Therefore, when you have a bond or preferred stock which is convertible, there is a price level at which the convertible and the common are worth the same dollar value. To calculate parity price of common stock, preferred stock, or bonds, the steps are: calculate the conversion ratio, which is the number of common shares produced, and use the par value of $100 of convertible preferred stock or $1,000 for convertible bonds. Step 2, use the shares produced from the conversion to determine the parity price of the common stock. So, market price of bond divided by common shares produced equals the parity price of the common stock, or common shares produced times the market price of common stock equals the parity price of a bond or preferred stock. So a convertible bond is quoted at 90 and has a conversion price of 50. So we go $1,000 divided by 50, we already did earlier, and that's $20. And then the convertible bond is quoted at $900. So I guess it would be 900 divided by 20. Doesn't seem right. What does the book say? So 38, 39. Oh, here it is right here. Convertible bond is quoted at 90 and has a conversion price of 50. So 900 divided by 20. I mean, the math is right. So it has a parity of $45. All right. now that you know how to calculate the parity price of common stock in relation to convertible bonds, let's examine when it would make sense to convert a convertible bond, convert a corporate bond or preferred stock into common stock. So the market price of stock, convert if the market price is above parity. Do not convert if the price is below parity. So this is a parity price. Got it. So a convertible bond is quoted at $800 and has a conversion price of $50. What is the parity price? So 800 divided by 50 is 16. Nope. 20, oh, not 50, it's 20 shares, my bad. So 800 divided by 20, there you go. So it's $40. So I would say that is not a good deal because the conversion price is 50. Anyway, a convertible preferred stock is selling at $120 per share with a conversion price of $20. What is the parity price of the common stock? Well, it's just stock divided by 20, so 120 divided by 20. $6? No, it's $24. A convertible preferred is selling at 120. That's the market price, and a conversion price of $20. So $100 on par divided by 20 is 5 shares. So 120 market price divided by the 5 shares is $24. Okay. All right. Let's do that one again. So here's another one. So convertible bond has a conversion price of $25. So then the common stock is currently trading at 23. Huh. So we got to figure out the shares first. So this one is $20 a share. So 100 divided by 20 is 5 shares. And 25 divided by 100 is going to be 4 shares. So then it's going to be sale price divided by the shares. Okay? Alright. So let's see if we can figure out the next one since I keep cheating. Alright, next one is number 4. An investor owns a callable convertible stock which is convertible into common stock at a 25 per share. So the convertible is going to be the parity. The current market price of the common stock is $30 and the preferred stock is called at 160. What should the investor do? An investor owns a callable convertible stock which is convertible into common stock at $25 per share. So it is I have no clue. Man, this is challenging. So let's read this here. So we have investor owns a callable convertible stock into $25 per share. So we got 4 shares convertible. The current price of the common stock is 30 and the preferred stock is 165. So 4 shares times 30 is 120 per share if converted to common sold. The call price is 165. The investor should let the stock be called at 165, which is $45 profit above the common shares could be sold at the current market price. Okay, I'm going to have to trust you on that one. Let's try one more. To calculate the conversion price, the formula is par value, which is 1,000, divided by the common shares produced, which equals the conversion price. For example, a convertible bond has a conversion ratio of 25:1 and is trading at 101. What is the conversion price per share? Well, 101 is 1.01 times 1,000, which is 1,010. So it's 1,010, and it's 25:1. Par value, common shares produced, wow, I did not get that. So a convertible bond has a conversion ratio of 25:1. Where does the 101 come from?